Why do you think they're too complacent?
I think the problem is that the tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. The Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty. The decline in merger activity in the 4 months of this year is pretty striking. People expected merger activity to pick up with the Trump administration. It's actually gone down because nobody knows what the rules of the game are going to be in terms of relative prices for inputs, relative prices for exports. So people are very confused, and people are just sitting on their hands.
Bill, as John was just saying, you wrote this line: markets seem to think that if the president won't stop the damage, the Federal Reserve will with rate cuts. Where do you think they have the political leverage to not cut rates at a time when they are seeing quite a bit of potential destruction to the U.S. economic outlook?
Well, it all depends on what happens to inflation, how high does it go, and two, does it get into inflation expectations? The inflation expectations are the key issue for the Fed. The second thing they're going to be focusing on, how much does the unemployment rate rise? It's not about job creation, it's about the unemployment rate. One thing that people don't really understand, I think, well, is the fact that we don't need a lot of job creation to keep the unemployment rate here because the growth rate of the labor force has collapsed with the Trump administration. We're deporting workers. The number of people coming over the borders has collapsed. The growth rate of the native-born population is really slow. So top speed for the U.S. economy in terms of keeping the unemployment rate where it is probably 50,000 payroll employment a month. And I think people think that 150, 200,000, if it slows to 50,000, the Fed's going to cut. I think that's wrong.
Bill, I understand the argument that the Fed put isn't exactly there, that the Fed isn't going to come in and cut rates in response to market turmoil. At the same time, there is an argument that some of the tariff-related inflationary forces are one-time price adjustments that will eventually come down, especially with a weakening economic outlook, and that they can look through that a bit more and place a bigger emphasis on the unemployment rate and other economic indicators. Do you push back against that?
Well, again, it depends on whether it gets into inflation expectations. The first Trump term, the tariff increases were relatively modest. It wasn't an inflation issue because inflation was running below the Fed's 2% objective. This time, the tariff increases are orders of magnitude larger, and it's happening at a time that inflation's been running well above the Fed's 2% objective for 4 years. So inflation expectations are the key. And one troubling indicator in that regard is what the University of Michigan household expectations survey showed last month for 5 to 10 year forward inflation expectations. It rose to 3.5%, the highest level since the 1990s. So if that is corroborated by other inflation expectations indicators, that's going to make it much more difficult for the Fed.
Bill, you're talking about the upcoming economic projections we're going to get from the Fed, and you say inflation will be increased, but the path for the unemployment rate won't change much as labor force growth slows along with hiring. Are you basically saying the Fed and their projections are going to almost pinpoint stagflation?
Well, I think they have to lower their growth estimates, given the uncertainty that the tariffs are causing and the fact that it makes real income for lower income households very much squeezed, and so they're not going to be able to spend very much. They have to raise inflation because the price level of a lot of these imported goods is going to go up pretty significantly. So I think that's sort of in the cards. I think what's going to surprise people is that they're not going to raise their unemployment rate trajectory very much. And I think that people maybe be surprised that they're not going to increase the number of rate cuts that they have in their forecast. Last time they had 2 rate cuts for 2025, and I think they'll keep it right there.
Bill, let's just talk about those forecasts. What is the approach to putting forecasts together in a moment like this? How much of a conversation happens between individual policymakers?
Actually, with regard to the summary of economic projections, everyone sort of does their own. So this is not coordinated. You are allowed towards the end of the Federal Open Market Committee meeting to change your forecast based on what you've heard from others, but people rarely do that. So these things are really put into place before the meeting starts and hardly ever changed.
A lot of people expect the statement of economic projection not to really move that significantly, and if they do, for it to essentially be irrelevant because they don't know anything. Do you disagree? Do you think that it will be indicative of what kinds of scenario analysis individual members are doing and how much they're incorporating policy for their outlook?
I think the reason it matters is the fact that I think people are looking for the Fed to sort of come to the rescue of the economy by cutting rates. And you've seen it in the decline in 10-year Treasury note yields over the last few months. And I think the Fed's going to signal through the Summary of Economic Projections and in Chairman Powell's press conference is that, no, we're sitting on our hands for the time being.